Hey everybody, the stock market has rebounded pretty significantly since we saw the reciprocal tariff announcements in April. But there are still some great opportunities to be found, especially when it comes to dividend stocks. Tyler Crowe is joining me. We're each going to be giving you a dividend stock that's on our radar right now that could be a great forever investment at the current levels. So we will get into them in just a second. Before we do, please take a minute and check out the link you see on your screen, fool.com/Frankel. You can get the top 10 stocks to buy right now from the Motley Fool. And I will put that link in the description. It is a great way to support this work we are doing on YouTube. Again, fool.com/Frankel. All right, so let's get right into it. Um, Tyler, you're looking at a company whose name doesn't really match what they do, right?
Well, maybe. So the name is a mouthful. It's Federal Agricultural Mortgage Corporation,
Well, that
kind of
name makes sense. The shortened version doesn't.
shortened shortened to Farmer Mac. Kind of like the Freddie Mac, Sally Mae, Fannie Mae, that sort. There, it's actually the same type of business as those. It is one of what is called a government service entity, which is a publicly traded business that has like a government mandate to basically buy approved mortgages and hold them and create what's called create a secondary market. It's a little technical, but basically, if you understand how Freddie Mae or Freddie Mac and Fannie Mae work, that's kind of describes how this business works. Um, but instead of doing housing mortgages, this is like agricultural mortgages. So, U.S. Department of Agricultural farm and ranch uh, loans. They do a lot of rural development loans. They do a lot of basically anything that's related to rural development in the United States probably goes through Farmer Mac. Unless it's specifically like residential houses, then it goes through Fannie Mae and Freddie Mac, and it's been as a business a pretty spectacular one. Look, I know it's a hard sell after what happened with Fannie Mae and Freddie Mac to be like, hey, it's just like Fannie Mae and Freddie Mac. That's great, right? Well, it this is actually one of the businesses that in terms of the government service entities they have been spectacular things to own, even if you look back at like the history of Fannie Mae and Freddie Mac pre-financial crisis. These were spectacular investments, if you were a stockholder of them, that just kind of got blown up. So yeah, again, my pitch is not great here, but if you think about, if you look at the kind of the guts of Farmer Mac, it's much more conservatively underwritten. If you look, it's like loan to value on most of its loans is it's less than 45% versus like your traditional home loan to value can be as high as 80%. So much more conservatively underwritten at the loan level. I think cumulatively, since it was inception back in the late 1980s, it's had less than $50 million in total loan losses. And this is a company with multiple $1 billion in loans on its books at any given moment. So it goes to show that this is an extremely operated business, very well underwritten, and it works within its mandate, and which has surprisingly grown shareholder value pretty spectacularly over the past 25 or over the past 10 years. It's grown its dividend annually by 25%, and it hasn't exactly slowed down either. Over the past year, it's grown it by 21%. So this is a business that, uh, on the surface, you look at the financials, look at all this stuff, it looks weird, right? Because it basically like owns mortgages, but it has turned out to be a pretty spectacular investment for for individuals who buy and hold this kind of business. 3.25% dividend today, growing at 21%. That's a pretty good value proposition in my book.
Yeah, no, that's definitely an interesting one. I'm going to talk about one that I think is more of an opportunistic play right now, and it is Ryman Hospitality Properties. I've talked about it before on these shows. Ticker symbol is RHP. They are a real estate investment trust that focuses on hospitality, and there are two sides of the business. On one side, they have large scale hotels that are focused on group events. If you've ever been to one of the five Gaylord hotels, those are all owned by Ryman. They have a couple of other ones. They just announced a major acquisition because I'm very bullish on this space. A great acquisition. They bought the JW Marriott Phoenix Desert Ridge Resort, which has been on their it's kind of like a watch list item for Ryman's management, if you will. It's one of there aren't that many hotels that really fit the giant group focused criteria that they look for. The Gaylords are 5 of the 6 largest hotels by meeting space in the United States outside of the gaming industry. So are if you don't want to, go to Las Vegas for your convention and you have a big group, one of Ryman's properties is probably a good fit for you. Um, its properties are absolutely iconic. They're very tough to replace. They'd be very tough to replicate. It's a really high barrier form of hotel. And it also is kind of a unique type of hotel with a potential recession on the horizon because unlike say when you go to go on vacation and you stay at a beachfront hotel, you generally book that a couple months in advance, right? If you if you're scheduling a group event or a conference that you expect to have 5,000 people attending, you're going to schedule that years in advance. The typical Ryman's group business makes up about 3/4 of its entire hotel business, and the typical group customer books at least 2 years in advance. It gives Ryman not only great visibility into future revenue, but it also gives them a nice little layer of insulation as, people book it before they know whether or not a recession is going to be going on in 2 years, 3 years. If they cancel, Ryman actually gets a nice cancellation fee. We saw this during the COVID pandemic. If a customer canceled, didn't reschedule their event, Ryman got a nice stream of cancellation income. So nice little insulation from recessions and things like that. Um, as it's not totally immune, but it's definitely better than most hotels. Um, right now, speaking of future bookings, in the first quarter, Ryman reported its highest average daily rate for future bookings ever. So things are still going really, really well in this business. They also the other side of the business is entertainment venues. They own a couple of iconic performance venues. If you're not a country music fan, you might not be that familiar, but they own the Grand Ole Opry. They own the Ryman Auditorium, which is where the company gets its name. It owns the Old Red dining and entertainment chain. Think of that as like a country version of House of Blues. They just opened a big flagship one on the Las Vegas Strip. Part of the business is growing very fast, has a lot of interesting potential, and they see the kind of ultimate goal of spinning it off in a few years as a separate business. Um, Ryman right now trades for about 20% below its 52-week high for a very low valuation. It has a roughly 5% dividend yield that's well covered by its cash flow, and management has a great history of making smart acquisitions that will build FFO over time. It's one that has been in my portfolio for a while, and now that it is trading at a pretty nice discount, it has kind of popped back toward the top of my list. So that's what I am watching right now. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.